You believe in one simple philosophy, which is investing is not a T20 or a one-day match, which is don't play with the white ball, play with the red. Classic test match.
I would also say within test matches, you have to find the kind of batsman you are, and we would maybe compare ourselves to someone like Dravid, right, where you want to keep your wicket intact and then the runs will follow, rather than taking a risk early on and and going for the fences.
See, what I also understand is you're sitting on 50% cash. So will IT companies get out of fashion?
IT is not IT. It's very specific companies doing very specific things. And the first cut would be, okay, which are the IT product companies and which are the IT services companies? These are companies that are blue chip companies that are well known, well researched, and so always correctly priced, sometimes maybe overpriced. It's very difficult for me to give by sector what is happening. I can tell you what we currently hold.
You don't invest in?
Yeah, you're putting me on the spot, huh?
In last 3 decades, I've interviewed chairmen, CEOs, fund managers, business leaders. But today, I'm actually excited to interview my partner, Rishi Gupta. Rishi has shepherded Shepherd's Hill over 3 major cycles in last 15 years. Euphoria, panic, despair, and excitement. And he has navigated them efficiently, smartly, by keeping it very simple. At a time when everybody has been shouting, claiming victories on what they've done, the USP of Shepherd's Hill is focus on not what you do, but what you don't do. So Rishi bhai, so excited to have you on the show. Thank you for joining us. It's the first time for me to interview my partner.
Thank you, Nikunj. Thanks for having me on your show where you've had so many eminent guests, and it's very humbling to be here.
When did you start managing money, and more importantly, when did you get the confidence that you can manage other people's money?
So I've been in the investment business for, I would say, 20 plus years now, because prior to Shepherd's Hill, I was in the US with a multi-billion-dollar private equity fund where we were analyzing and investing in privately held companies. And actually, analyzing a private and a public company are one and the same thing. It's just that in one case, the shares are liquid, and in the other case, they are not. But your fundamentals of how you analyze a company, how you analyze management, what are the factors to look for, they all remain the same. So after that initial phase of mine in private equity, in 2011, I moved back from the US to India to begin Shepherd's Hill and public equity investing. And I've been doing that since then. So it's been 15 years. And in terms of confidence, I don't know if I had that much confidence to at the outset, but there was a certain level, I guess, of self-belief. It was a question of finding the right philosophy and the right framework, which by 2011 that had happened. And the question was, should the skill set that was developed by then be applied in an economy that was growing at 2% real growth or 7% real growth? And given that I was born and brought up in India, had complete knowledge about this economy and the market here, it just made a lot of sense to apply that skill set in India versus the US, and that's what prompted me to move back and start Shepherd's Hill.
One refers to the data available in the public. According to public data, the CAGR track record of Shepherd's Hill Group is about 22%, which means if somebody associated with you 15 years ago and you started managing 1 lakh rupees, in 15 years that has multiplied to about 18 lakh rupees, whereas the index, it has only gone up from 1 lakh rupees to 5 lakh rupees.
Right. So obviously these are various phases of our journey and different products. So I cannot publicly comment on specific performance numbers. But yes, we have had a Big Four auditor come in and look at all our contract notes since the group's inception, which started as an advisory firm even before the SEBI advisory regulations were in place. Then when the advisory regulations came in, we got the advisory license. In 2015, we got our PMS license. And in 2018-19, we got our AF Category 3 license. So, so the performance is spread across these various products, and I won't go into the various performance details of each product.
You believe in one simple philosophy, which is investing is not a T20 or a one-day match, which is don't play with the white ball, play with the red ball. Classic test match. Walk us through this investment philosophy.
Yeah, so I mean, we are definitely closer to the test match analogy purely because we need to stay for the longer term. That's the philosophy that we believe. We need to leave a lot of the balls outside off stump. I mean, we know where our off stump is, and if it's likely to create a nick and get the wicket, we will stay away from that. A test match allows you to bat yourself in and then wait for the right ball and play it. So similarly, in the way we invest, there are thousands of listed companies. All we have to do is collect and curate about 15 plus minus companies for the portfolio. And so that means after going through the entire process, saying a lot of no's, maybe there will be some companies that are difficult to analyze for various reasons. We will stick to our circle of competence, and we will pick and choose very carefully to come up with the 15 companies for the portfolio. So that's why the test match analogy is sort of more pertinent in our case. I would also say within test matches, you have to find the kind of batsman you are, and we would maybe compare ourselves to someone like a Dravid, right, where you want to keep your wicket intact and then the runs will follow, rather than taking a risk early on and and going for the fences.
So Rishi, the most standout feature, at least for everybody, is that the number of stocks where you've invested in last 15 years, you've only invested in 37 stocks, and the average holding period is about 5 years. Now that is serious amount of, I would say, omission and very few bets. Walk us through that process.
It's good to hear those numbers, Nikunj, that it has worked out that way. Basically, it is what are the companies that either we don't understand fully, which is this one.
I don't know.
Either too hard to understand,
okay,
or outside our circle of competence. Then there are ones where we would say no either for a fundamental reason or the very other important other piece being price. So there might be a company that we actually like, but the price might be too high. That will come into this bucket, which would be a no. And then if fundamentally the company is sound, prospects are good, and price is also good, then only will they fall into the yes bucket.
So let's talk about the current market scenario. In the current market scenario, and since markets, they follow a cycle, how would you currently really describe the market cycle for us? It is not euphoric, but it is not as painful as what we saw in COVID.
I think the current scenario, what has happened is prices were already high for a while. About, I would say, for the last 18 months, prices have been high, not counting the last 1 or 2 months. And the prices in the market in general, now I'm speaking only in general terms, please don't, extrapolate that to any specific stocks, because that might be different for each and every company. But in general, prices have been high, and with this current war that is happening in the Middle East, coming up, I think it has given the market a reason to correct even further. And so for these sad reasons, what is finally happening in the market is that, you're seeing certain pockets and certain companies where it is starting to become attractive for a long-term investor.
So markets are fairly valued, can I say that?
I would hate to qualify or categorize the market as a whole. It's not something we do at Shepherd's Hill, but I can see there are opportunities now arising.
Historically, portfolio managers, they always like to stay fully invested. The reason why they like to fully invested is because when you're sitting on cash, you're timing the market. When did you decide to stay on 50% cash, and why are you sitting on 50% cash?
Right. So this was not any kind of macro call. This was not a strategic call. It just happened that I would say about 18 months ago, we started seeing that some of our companies were highly priced, and we started slowly getting out of those companies. So the way we work is we have a buy bucket, we have a hold bucket, and we have a sell bucket. And obviously everything in the sell bucket, we will start selling. And if there are ideas to buy, we will buy. And for the hold bucket, we will hold for existing clients. And if new clients come in, we might not buy for them, but we will continue holding for the older clients. What happened about 18 months ago is that we started selling, but we didn't have enough buy ideas to buy with the cash or for clients that are coming in into the fund. And so it was a natural process that we followed, and it just happens to be that now we are in 50% cash. I would say if you count one or two other placeholder companies which we have either bought for dividend yield or not the very long term, purely because there were lack of ideas, we would even be at maybe 60+% cash holdings, cash and cash equivalents.
Exactly. Cash. When will you start deploying it again? And if you have to deploy, what would be that? Where are you treasure hunting right now?
So we are very close to deploying now. The work is going on. We already had a short list, a shopping list, if you will. It's not like we were sitting idle for 18 months. We constantly monitor what's happening. And so we are now getting close to that point where we will start deploying. Now obviously, these might be 5 or more positions that we will enter.
Now, market returns are made not on looking at past performance. You have to bet on the rate of the change. Every company, they go through a mature curve. What is looking young and bright in a couple of years from now could look fat and obese. Indian IT companies today are getting smashed, but 20 years ago they were the high growth companies.
Yeah.
The world is changing. In this conservative style, when you're trying to look at companies which will last for 15 years, 20 years, they will also go through their own learning curve, they will also go through their business cycle, they will also go through their maturity curve.
Yes.
Isn't that too dangerous to buy a company which you think will survive for 20 years, but if it survives for 20 years, then the growth rates would be different. P multiples will also change.
In some businesses, it might be a technology advantage. In some businesses, it could be the entrenched position of the business. So it really depends business by business, but something that should give an investor comfort is at least the last 5 to 10 years track record. So my suggestion would be not to give too much of a premium to growth expectations. If growth comes in, that's a good kicker to have in your analysis and your expectations, but you should be able to reliably judge what is the earnings power of that business.
Okay.
And there are various factors, like I said. So competitive scenarios, are there threats from outside the industry? I mean, in our day and age with AI coming in, that's a very good example of something externally coming in and disrupting businesses. We just saw the other day a large US-based product company laying off 12,000 people in India and maybe 30,000 people worldwide. So this is going to come, something like AI is going to come for most companies, and you have to be sure that you will be able to weather that storm. Your customers will still be looking for you to provide value. Your cost basis, remains an advantage. So it's a whole host of things that you have to look at.
Okay, so let's look at two sectors which at least couple of years ago I never thought they would ever be challenged. One is challenged because of disruption, AI, that's IT, and second is getting challenged because of distribution,
Right.
which is consumer. AI, it's a real deal. We know that. It's like electricity. The use case is going to increase more and more. But electricity led to a huge uptick in productivity. Steam engine made life easy for everybody. Internet is a real deal now.
Yeah.
Where do you stand in terms of identifying an opportunity which could be either a second derivative beneficiary or a third derivative beneficiary because of AI?
So we would look at something like this more defensively than offensively. So perhaps we will not look for what will be the next AI winner, because it's a very nascent industry, and there is the famous example of when the auto industry was growing in the US. The idea was not to find, the winner in the auto companies, because that was a very difficult thing to do. But you could then look at the fact that horses were going to go out of fashion.
So will IT companies get out of fashion?
So again, it's nuanced. I think overall in the investment business, it's very difficult to paint with a broad brush. So a very rough cut initially would be, IT is not IT. It's very specific companies doing very specific things. And the first cut would be, okay, which are the IT product companies and which are the IT services companies? And then you have to look at, okay, how will AI affect a product company? Within product, you'll have very large entrenched product companies, right? And then you'll have niche product companies. You'll have to look at the sector in which you're entrenched. For example, if you're a software company, product company that has banking sector as their customer, maybe you're slightly more entrenched because there are regulatory impacts, versus maybe a consumer facing product company might have less, of a moat around it. Services companies, you'll have to look at and see, okay, can they still provide value? Because a lot of companies are going to need, rejigging of their entire process. And will a services company be able to use AI tools to give their customers what they need? Can they give outcome based, sort of contracts versus just a pure cost plus base? So, and this is just a very rough first cut. So there are many layers, and you will have to look at it company by company, sector by sector, to come up with an answer.
Okay, now let's look at the other D which is changing, distribution. Thanks to internet, channels are getting broken. The monopoly of big FMCG companies, which was only centered around penetration and getting rack spaces, that is getting challenged. Indian consumer stocks have not gone anywhere. Just se baithe hain, thande hain. But that's the space you like. Anything which is not gone anywhere, it's a good company, go and buy them. Are consumer stocks, consumer staples looking attractive now?
So I'll go back to my point about fundamental and price combination. So fundamentally, we love it.
Okay.
We love consumer companies that have an entrenched position in the mind space and mind share of the customer, right? But I'll tell you, in our history, we have owned very few of them because everybody knows these are good companies, right? Everybody knows a Unilever I wouldn't say Asian Paints is direct consumer, but there is a component of a consumer decision making in Asian Paints as well. These are companies that are blue chip companies that are well known, well researched, and so always correctly priced, sometimes maybe overpriced. So, and now what you're saying is correct. I mean, it has sort of moved sideways for a bit. I still am not finding, to be honest, very clear screaming buys in the space, but we will constantly be on the lookout. And
are you a big believer in what are called as mega trends? For example, defense has now become a mega trend. Consumer had become a mega trend a couple of years ago. EV has been a mega trend. At least people are calling it out. Do you believe in buying some, investing in some of these so-called mega trends or narrative stocks?
So if you put a gun to my head, I will make the statement that wherever the mega trend is, you'll see me running in the opposite direction. Although you mentioned EVs, and I mentioned my private equity career before I started Shepherd's Hill, and I was one of the first EV investors in the, outside investors in an EV company, a small company called Reva Electric Car Company, which is now Mahindra Electric's portfolio, and and then we were very early in those days, because this was, I'm talking about 2008. So at that time it wasn't a trend, and of course these were decisions, since I was a junior partner then, these were decisions made by my bosses, but in general you'll find me in the opposite direction of a mega trend.
So what does this box contain then? इसमें क्या आने वाला है?
Yeah, that's a good question, and it's again because we don't do a top-down analysis, we focus on bottom-up. It's very difficult for me to give by sector what is happening. I can tell you what we currently hold, not by name of course, but we do have some, one or two specialty chemicals companies. We have a couple of small banks, right? We have one or two energy plays, right? So currently it's a little bit, there is one healthcare company. So it's, again, this is not a strategic call we took, but it just turns out that we own what could be considered a defensive portfolio currently, right?
So the fact that your portfolios essentially are not, the idea is to beat the benchmark, but there is no concept of index hugging. Can I say that when you're buying a stock, you don't look at the index valuations, you don't look at the index weightage?
Yeah.
It's simple buying good businesses at a reasonable price?
Yes, because index hugging, what is the point of index hugging for an active manager, right? I mean, we have seen in the US that a large piece of asset management has moved towards passive investing any case. So if you feel you can bring alpha to the effort, then there is no point hugging the index, because someone can do it at a much lower cost. Why should someone pay you your fund management fees? Is because you can provide that alpha, and you can only do it by staying away from index hugging and having a more concentrated portfolio and doing it correctly.
The other place which you have never invested in is that you don't like to buy loss-making companies, right? Now, of course, there's a discipline here that let the business model first prove itself. Then only equity investors will make money. I mean, future investing is buying cash flows. If a company is not generating cash flow, then as an equity investor, where do you really get value for what you're investing in? But the world is changing. Graham said buy companies which are below the intrinsic value. But that was 1930s and 1940s. The world was different. We were recovering from World War. Buffett talked about investing in consumer monopolies. The time was different. America was just getting built up. Loss-making companies are the ones which are the most exciting companies right now. Amazon was a loss-making company. Eternal was a loss-making company. So this disciplined approach of yours of not to invest in a loss-making company, wouldn't you be missing out on future growth companies then?
So I would qualify that by saying that we will not invest in perpetually loss-making companies.
Like the Uber IPO.
I mean, it could be, it could be an Uber, it could be an Amazon in the past, which had multiple years of losses. It's very difficult for us to look out 10 years and say, okay, after 10 years, the company will start making profit, and then make a responsible investment decision based on that. But if I can see that 2 years out, 3 years out, 5 years out, there is a clear path to profitability, I won't rule it out. The comfort as a value investor lies in a consistent track record of profitability. Those are the easier decisions to make. And as you can see, you use these props nicely to explain that we want to make easy decisions. We don't want to, if it's too difficult a decision to make, then I would rather put it in that bucket. So never say never. We might invest in a loss-making company there where we see a path to profitability. But in general, if there's a track record, last 5-10 years, there are 4 or 5 years that there are losses, the situation doesn't seem to be improving, or there are some key fundamental factors that are blocking its path to profitability, then we will not invest.
You don't invest in?
Yeah, you're putting me on the spot, huh? So, IPOs are heavily marketed, events. The world's best and the country's best investment bankers are, dress up a company to to be able to raise primary capital. It's a very important job that they're doing. Let me not take away from the fact that it might actually be the main task of the stock market. Secondary investing is a secondary task, therefore the names primary and secondary, right? So the primary capital raising is a very important piece of a capital, driven system. Having said that, as the buyer, I would not like to go into a situation where it is a seller's market. Prices are being set, expectations are being raised, there's a lot of buzz, a lot of marketing around it. And as a conservative value investor, I want to stay away from that. I don't mind 3, 4, 5 years later going back and looking at the good listed companies that were listed that much time earlier, and then once the buzz has died down, but and maybe the price has gone sideways, but the performance has continued to improve, that's a very good time actually. That's a little bit of a trick that you can use to maybe filter out your potential investments, is to look at IPOs from 5 years ago.
So Rishi, if somebody is invested in Shepherd's Hill now, over a course of one market cycle, what should they expect?
No, I think we obviously don't, legally also we're not allowed to, but we just generally don't give very hard and fast expectations. What we can show a prospective investor is our track record, where there has been significant alpha, and the fact that historically over 25-30 years the Indian equity markets have done around 11-12%, and we have a track record that says that we should be able to continue to do that. Given that we are now sitting on significant amounts of cash and cash equivalents, we certainly have an advantage compared to people who are fully invested, and that should hold us in good stead.
Well, Rishi, we've spent the last hour talking about the mechanics of the wealth, the strict off-stump philosophy, the heavy bat approach, and the entire concept of fear and greed. Thank you for joining us on the show, and thank you for your time.
Pleasure, Nikunj. Pleasure. Thank you.